Afternoon everyone, we are going to discuss about the chapter on provisions for filing of the return of income and self-assessment. The first section which we are going to cover is compulsory filing of return of income under section 139(1). So, who needs to compulsorily file the return of income? The companies and the firm, irrespective of their income, needs to compulsorily file the return of income. Or it might be a loss, they need to file the return of income. In case of a person other than company or firm, it can be individual, HUF, AOP, BOI, if their income exceeds the basic exemption limit, then in such cases they need to file the return of income. Every person who is a resident other than not ordinary resident. So who is a resident other than not ordinary resident means resident and ordinarily resident. He is not required to file the return of income under section 139(1). He needs to file the return of income provided in the two cases that he is a beneficial owner of any asset which is located outside India, or he has a signing authority of any account which is located outside India, or he is a beneficiary of any asset, means he is deriving any benefit from any asset which is located outside India. However, beneficial owner, if he includes in his total income this income, then in such cases beneficiary need not file the return of income. Next, this basic exemption limit is before giving effect to the reductions. You need to see whether you are opting for a new regime or you are opting for an old regime. In case of a new regime, whatever is there, or default taxation regime, or in other words 115 BAC, then in such cases only certain deductions are allowed. That is 80CCD2, 80CCH2, 80JJAA and capital gains deductions are available. So these, before giving effect to these deductions, means whatever deductions are there, you have deducted the reduction and you have got the total income. You shouldn't see the total income. For example, you have the income of 4 lakh gross total income. After deductions, your gross total income is 2 lakh and your net income is 2 lakh after giving effect to the reduction. You shouldn't take 2 lakh. You need to add back the reduction of 2 lakh. You need to consider 4 lakh for the limit. Okay. So that is in case of default taxation regime. In case of old regime, all the deductions are available. You need to add back the reduction, and if it exceeds the limit of the old regime, whatever limit it might be, it can be 2,50,000, 3 lakh or 5 lakh as the case may be. As you all know, for a certain aged individual, in case of individuals we have different limits, and in case of HUF, AOP, BOI, we have only one basic exemption limit. So based on this, you need to calculate the basic exemption limit. So now, the person other than company or firm, they are not required to file the return of income as per 139(1). They need to file the return of income provided they have deposited an amount of exceeding 1 crore in one or more current accounts in a banking company or cooperative society. It is a single amount or aggregated amount. Okay, so for example, I've deposited 25 lakhs during the financial year in current account on 1/4/2024, assuming the previous year is 24/25, and again 25 lakh on 30th September 24 in SBI only, SBI current account only, and another 30 lakh in Bank of Baroda current account. Okay, and again another 30 lakh in Bank of Baroda current account. So now this limit has exceeded 1 crore, right? So now I need to file the return of income, because here they have told an amount or aggregate amount. So during the financial year, if you have deposited the whole amount or aggregated amount, then in such cases you need to file the return of income. Then you have incurred expenditure of an amount or aggregate amount exceeding 2 lakh. So if you have incurred an expenditure exceeding 2 lakh for that person or any person for foreign travel to a foreign country, so here also it is exceeding 2 lakh. And if you have incurred an expenditure toward the electricity bill exceeding 1 lakh, so here everything is exceeding the limits, that is exceeding 1 crore in case of current account, exceeding 2 lakh in case of foreign travel, and exceeding 1 lakh in case of electricity bill. So here the amount needs to be aggregated and not the single amount. And again they have given certain other conditions, wherein if the total sale, turnover or gross receipts exceeds 60 lakh during the previous year. So in this year, for example 24/25 is my tax year, financial year. So then in such cases, if my sales, it might be, or turnover, it might be, gross receipts in case of a business, if it is exceeding 60 lakh, then in such cases I need to file my return of income. Or in case of gross receipts, if it is exceeding 10 lakh, then in such cases I need to file the return of income. And the TDS, TCS, whatever is there, if it is exceeding, if it is 25,000 or more in case of a person. So person means here it is other than other than company or firm, right? So other than company or firm, if the TDS, TCS limit is exceeding, if it is greater than or equal to 25,000, then in such cases compulsory filing of return of income, even though the income is less than basic exemption limit, provided in case of a senior citizen who is aged 60 years or more. Then in such cases the TDS, TCS limit is 50,000 or more. And then deposit in one or more savings bank account is 50 lakhs or more during the previous year. So if the deposit is 50 lakhs or more, then in such cases the return of income need to be filed. All such person mentioned in 1 to 5 above should on or before the due date furnish the return of income. So now due dates we need to see for filing the return of income under section 139(1). Now 31st July is for SSEs who are not covered under 31st October and 30th November. 30th November is in case of a SSE including the partners of the firm who need to furnish transfer pricing report. 31st October is in case of audit cases like company and a person which is other than company whose accounts are required to be audited under the Income Tax Act or any other law, and partners of the firm whose accounts are required to be audited under Income Tax Act or any other law. So partner of above means partner of the firm who are covered under the audit cases. So they are the firm's, like, see now for example the firm's income is computed, only then the partner's return can be filed, right? So practically whatever the firm's income is there, only after computing that you can file the partner's return. So logically it is like that. And 31st July is for all the SSCs like who are not covered under the audit cases. They need to file the return of income on 31st July. Okay. Here, I need to mention one thing, that is NRE account. So NRE account is an account which is required by the RBI that needs to be maintained. Okay. So here, whatever interest on the NRE account will be exempted. So it will not be taxed. Then they have told that 30,000 in respect of the interest on FD with SBI. So interest on FD that needs to be taken under the income from other source. And they have also earned 3,000 on interest on savings account. They have not mentioned whether it is NRE. So we'll take as NRE. So 3,000. So if you add that, the income comes up to 33,000, which is less than the basic exemption limit. Okay, less than the basic exemption limit. So now, assuming this Paris, whoever is there, is opting for the new scheme, default scheme, that is 115 BAC, before giving effect to the reduction, it is 33,000. It is less than the basic exemption limit of 4 lakh, right? So since it is less than 4 lakh, it is not taxed, but the return need not be filed. But in this case, he has incurred 3 lakh on travel expenditure. So what we had seen, if the expenditure is exceeding 2 lakh in case of foreign travel, either for himself or any person, so they have not mentioned either it is spouse or anyone. So since they have told here that it is also for the spouse, so that 3 lakh whatever is there, so since that is exceeding 2 lakh, he needs to file the return of income. Next is return of loss, that is 139(3), section number 139(3). So in case of loss return, if you want to carry forward the loss, so whatever losses might be business loss, speculation loss, loss from a specified business, capital gains, and loss from the activity of owning and maintaining race horses. If you want to carry forward all these loss, except in case of house property income from house property, if there is a loss in that or unabsorbed depreciation, except those cases, you need to file the return of income on or before the due date if you want to carry forward the loss. So if you don't file the return of income within the due date, you cannot carry forward the loss. So house property and unabsorbed depreciation can be carried forwarded even if you file the return of income later, that is after due date. Then we have belated return. So now, if I have to tell loss return, if it is not filed within the due date, it becomes belated return. Okay, so because it is not filed within the due date, and also 234A will apply. And then in case of belated return, it is if you have not filed the return of income within the due date, then in such cases belated return will be applicable. So suppose 24-25 is the financial year, and if you have not filed the return of income by 25-26, that is 31st March 26. So 31st March 26 is the end of the assessment year, right? So belated return can be filed on or before 31st December 2025 or before completion of the assessment, whichever is earlier. And revised return also, the same thing is allowed. You can revise the return only if you have filed the original return. So if any person having furnished 139(1) or belated return, if there is a wrong statement, he may furnish the revised return. Same due date. So can I revise loss return? Yes, you can revise the loss return. So how many unbelated return? Can I revise the belated return? Yes, you can revise the belated return. How many times can I file the belated return? Any number of times. N number of times you can file the belated return. Can I revise the return once filed? So can I revise the revised return? You can revise the revised return n number of times, but within the time limit, that is 31st December of the assessment year. So now 234A is default in filing the return of income. So there is a tax liability of 2 lakh and 31st July is the due date. You have not filed on 31st till December 3rd. Means you have filed it on December 3rd. Now, what is the 234A interest which is levied? It is 1% per month or part of the month. Now, 31st July is the due date. August, September, October, November, December, they have told 1% per month or part of the month. Even if it is part of the month, then also 1% interest will be levied. Hence, for 5 months, 1% on the tax liability will be calculated, which comes up to 10,000. So the liability is, total tax liability is 2 lakh plus 10,000, that is 2 lakh 10,000. So now updated return. So updated return can be filed 48 months from the end of the relevant assessment year. So this is irrespective of whether you have filed 139(1), that is original return, belated return or revised return. So this is irrespective of that, you can file the updated return. So now this updated return is not applicable in case of loss return, provided you want to revise the loss to a return of income, or if it has a decreasing total tax liability. So decreasing total tax liability, if it is there, then in such cases, so liability you have paid in the original return is 10,000. So now you want to say that I want to pay 5,000. So you cannot revise the return of income. And loss return. So suppose you want to show a loss of further 2 lakhs. So you cannot file a return of income, updated updated return, because here it will not take. And then if it is increasing the refund, so if you have got any refund, or if you have not filed any belated return earlier, you want to claim refund, you can't claim the refund in the updated return, because only and only if you have any taxes to be paid, only then you need to file the updated return. So when you're filing the updated return, you'll get an additional penalty. So additional penalty needs to be paid, or late fee, whatever is applicable, that needs to be paid. Suppose you have not filed earlier return, then in such cases 234A, that is default in filing the return of income, so that will be levied. And 234B, C, all those things will be levied. Over and above that, there will be 25% penalty, 50%, 60% and 70% penalties respectively for each year which crosses from the end of the assessment year. So whatever taxes are there, that will be paid. The same thing is explained here. Like, see, if it is within 12 months, then in such cases from the assessment year, ending from the assessment year, then in such cases 25% of the tax and interest, whatever is there, on that 25% needs to be calculated. So if it is the return is furnished after 12 months from the end of the relevant assessment year, but before 24 months, then in such cases 50% of the tax and interest, whatever is there, that needs to be paid. So if the return is furnished after the expiry of 24 months from the end of the relevant assessment year, but before completion of the 36 months from the end of the relevant assessment year, then in such cases 60% of the tax and interest needs to be paid. If such return is furnished after the expiry of 36 months from the end of the relevant assessment year, but before completion of 48 months, then in such cases 70% of the aggregate tax and interest need to be paid. Okay, so here they have given certain case scenarios, and they have told like tax liability is so much, TDS is so much, interest is so much. So in each of the cases they have given. So now there is a assessment year 2021. Okay, this income is related to this year. Now this person wants to file the return of income on 16/5/2025/26 or 16/5/2025. So now if he wants to file on 16/5/25, now we need to see 48 months from 2021. So we need to see whether it falls within 48 months from the end of the assessment year. So if I calculate 2021, this is the assessment year, end of that means from 21, 22, 22, 23, 23, 24, 24, 25. So after 31st March 25, he can file the return. If he has not filed, then in such cases he cannot file the return of income. So he cannot file the return of income on 16/5/2025. Now in the next case, 21/22. So till 25/26, that is 31st March 26, I can file the return of income. Let's see whether it falls under the non-applicability cases. So we have tax liability of 5,60,000 and TDS of 10 lakh. Now there is a case of refund. I've told you the criteria to see is there should be tax. Whatever tax it might be, there should be tax payable. So since it is a refund, you cannot file the updated return. Now we have a case of a tax liability of 6,30,000. They have given TDS, that is 2 lakh, and there is a self-assessment tax which is paid. So whatever tax has been paid, it will reduce the tax liability. So now the net tax payable comes up to 4,20,000, I need to see whether it falls within 48 months. We know that it falls within 48 months. So since it falls within 48 months, now what I need to do is, in which of the penalty cases I will follow. That is whether it is 25%, whether it is 50%, whether it is 60%. So when I see that, I get to know that now assessment year 2022-23, right? If I file within 31st March 24, then in such cases 25% I will get. Within 31st March 25, then I will get 50% penalty. Within 31st March 26, I will get 60% penalty. So since I fall in the third year, I get a penalty of 60%. Of 4,20,000, I need to calculate 60%. I need to file the return of income after taking into penalty plus the tax whatever is payable and pay off the tax. File the return. Next case is, this person has claimed a loss of 3,50,000. He needs to claim. Now he wants to claim the loss, additional loss. So additional loss cannot be claimed, and then what we have is 7,50,000, whatever income is there. He has once filed the updated return. Again, he cannot file the updated return. So once updated return is filed, again you cannot file the updated return. So next it is defective return. So defective return means either you have not furnished certain details, or there is a mismatch in TDS, TCS, or the form whatever you have selected that is not proper. For example, it is ITR 1 you have selected, ITR 3, ITR 2. So whatever form is there that is not or you have not uploaded the financial statements. So in these cases, the return will be considered as defective. So whenever there is a defective return, the assessing officer will give a time period of 15 days to rectify the defect. Now, a further time period may also be given if application is made. Now, if the SSA does not rectify the return, then in such cases return will be treated as invalid return.